A Limited is a company which is in the business of manufacture of engineering machines and provides after-sales service. The company is entered into the contract with Mr. Sankey to supply and install a machine, namely a Model Pi. In 18th April 2018, a service this machine is 30th September 2018. And in 18 1st April 2019, the cost of machinery is it was 1,60,000. It is possible for the customer to purchase both the model machine, Model Pi, and maintenance service separately. Mr. Akir contractual obligation to pay rupees 4 lakhs on the 1st April. And the prevailing rate of 1 year credit granted to trade customers in the industry 5% in on 6 months period. As per the experience, service of the machine Pi model sold to Mission Uncle expected to cost Mr. A 30,000 to perform the first service and 50,000 on second service, performance of second service. The actual cost equal expected is cost. Then the Mr. A provide the machine provided to consumer in separate transaction and earn a margin of 50% on cost. On the 1st April 2019, the cash selling price of the Pi model was 2,51,000. The promised supply of machine Pi, model Pi, and maintenance service obligations satisfactorily carried out in the time of the company. You are required to segregate the component of a transaction of Mr. A and shall supply to the revenue recognition criteria of Ind AS 115 and calculate the amount of revenue Mr. A is allocate such a component of transaction and prepare a journal entry to record the information set as above the books of account on A Limited on 31st March 2019 and 31st March 2020. The draft of the extract shows how revenue could be presented and disclosed in the financial statement of Limited for the year end 31st March and 31st 2022. According to para 27 of Ind AS 115, a goods or service which is promised to customer is distinct in both of the criteria are met. The consumer can benefit from the goods and the service either on its own or together with the other resources that is reliably available to them. Readily available resource is a goods or service that is sold separately by the entity and another entity, or the consumer had already obtained the entity from other transaction event. The entity promised to transfer goods and service to the consumer. It is separately identifiable from other promised in the contracts. The factors that indicates two or more promised that the goods transfer of goods or services to the consumer are separately identifiable include but not limited to the following. Significant integration of service not provided, that is, entity is not using the goods or service as an input to produce or deliver the combined output called for this contract. The goods and service does not significantly modify the circumcise other promised goods or service in the contract. The goods and service are not highly interdependent and highly integrated with the promised goods or service in the contract. According to 1st April 2018, the entity A entered into single transaction, three identified separate components: sale of goods, engineering material, rendering service, engineering machine maintenance on 30th September and 1st April, and provide financing, sale of engineering machine, and rendering cost, rendering of services, extended period credit. Three things. Calculating the allocation of revenue in each component. 1st April, goods 2,80,000 bought, closing balance. 30th September, and finance income 12 lakh 8 12,596. How 2 lakh into 5%, 12,596. Then service 45,000. That they gave service 45,000, 4 lakhs 30,000, 15,000. So closing balance 3 lakh 9,000. Then after 3 lakh 9,000, 15 percentage, 5%, 15,000. And then after 3 lakh 26,000, 20,000, 75,000 for services. Then totally we received 4 lakhs. That is payment received. This is how you want to account. 45,000, 75,000. But actual cost is to 4 lakhs is the model win, 5 percentage, 30,000 plus 50,000. Sold expect to cost 70 performed in the first service and for 50,000 the second one. So 80,000 is service cost, but they charge only 50,000. Mr. Akhil to revenue account 2 lakh 51,000 on first year. Then after Akhil to revenue sale of goods, then cost of goods 1,60,000 to inventory. Mr. Akhil to finance 12,50,000 income. Mr. Akhil to revenue regarding 45,000 on the revenue from the rendering of maintenance services. Then cost of service for 30,000. 30,000. How 45,000 they have mentioned how because they have clearly said here. Wait a minute. 3% margin on cost he has given. Na? That is the reason. 50% on cost is 30,000 into 50% is 45,000. And second is 50,000 on 50,000 is 25,000. 25,000 plus 50,000, 75,000. Mm. That's what it's come. Okay. Cost so cash to bank for like extracting amount. Okay. Mm. Extract notes of financial statement of 31st March. Sale of goods 2,17,000. Rendering of machine 75,000, 45,000. And here finance income 28,000. How to adding both this and this 15,000 plus 12,000 28,000. So totally cost sale of goods on the 3,25,000 and rendering income 75,000. So totally 4 lakhs.